And now for commodities market update, we have Dr. Adesola Sumoni, analyst, financial derivatives company, join us via Zoom. Great to have you on the program.
Great to have you. Thanks for having me, Ladi.
Yeah, always great to have you. So, Dr. Adesola, we're back again, with this market. The volatility is still there, but we're seeing a bigger move, downside.
Yes, indeed, Ladi. The oil market has been volatile this week, and I think yesterday we saw almost a 4% decline in Brent crude price, and that was driven by a host of factors. So on the demand side, we have larger than expected build-up in gasoline stockpiles in the U.S. Analysts expected a build-up of around 380,000 barrels per day. 380,000 barrels. Meanwhile, the actual build-up, according to data from the Energy Information Administration in the U.S., showed a build-up of around 3.1 million barrels. Also, we saw a larger than expected build-up in crude stockpiles. And usually, build-up in crude stockpiles signifies signals weakening demand. In addition to that, we're also seeing surging cases of coronavirus in China, or COVID-19 virus in China, and taken together with China's zero tolerance policy, we are seeing a lot of lockdowns, a lot of slowdown in economic activity, and that also has implications for energy demand, particularly because China is one of the largest importer of crude oil globally. So the slowdown in economic activity as a result of coronavirus is also dampening oil demand. Furthermore, we are seeing, still on the demand side, we saw an economic outlook from the OECD, which forecasts, slowing global economic growth for 2023. And this again points towards, slower or weaker or softer oil demand for 2023. So those are the factors on the demand side. On the supply side, I think this is also one of the biggest factors affecting oil on the supply side is Russia. So the EU, the G7, I beg your pardon, it plans a price cap on Russia to cap the price at which Russia is able to sell their oil, and the cap is, according to some sources, ranges between $65 to $70 per barrel. Now that is quite interesting because Russia is currently selling its price below that level. We said previously that Russia is having to sell its oil at a discount because of its war in Ukraine. So now this price cap is above what Russia is currently selling its oil, and that is good for Russia. Anyone who did economics, I would tell you that for a price ceiling to be binding, it needs to be below the equilibrium price. So with price cap above what Russia is currently selling, it is still profitable for Russia to sell, and the cost of production for a barrel of oil for Russia is around $20 per barrel. So it's still profitable for Russia to sell oil, and Russia is able to sell oil.
So Desola, do you think the right cap, if they're looking at a real cap, what do you think that would be? Around maybe 10 to $10?
Oh, obviously. No, but for the cap to be effective, for the cap to be binding, it needs to be below what Russia is currently selling its oil for. Russia is selling oil to north of Europe for around $62 to $63 per barrel, and to the Mediterranean around $67 to $68 per barrel. Meanwhile, the cap is looking at an upper bound of $70 per barrel. So there's still some wiggle room. However, the US, I think the Secretary of State of the US has said the cap would be kind of adjustable. So we may see the cap adjusted below what Russia is currently selling, and then that would be binding, and that would have an effect on global oil supply.
All right, what's happening with our external reserves? It's down about 1.34%. Is that downtrend back again?
I won't call it a trend yet. For something to be a trend, it has to be continuous, right? So what is happening is, I think the central bank is trying to reduce the depreciation of the naira by injecting some more dollars into the market. Like we know, in the past couple of weeks, the naira was depreciating quite sharply, but we are seeing the naira begin to appreciate now. I think part of it is because of the central bank is injecting more FX into the market. Also, we are seeing lower oil receipts. We are seeing oil prices are quite relatively lower. Today oil prices are around like $85 per barrel. A month ago, they were I think about $90 per barrel. So we are seeing also lower oil receipts. And so those factors together are why we are seeing the external reserves decline.
Right, and so much, obviously happening, in that forex market. But now bring us up to speed on what's happening with domestic commodity market.
So domestic commodities market, the prices are trending upwards, Ladi, and I mean, yesterday FDC does this presentation by my colleague Bismarck Rwani, and he said it's going to be a beery Christmas and a sappy New Year, and that's because while there's these festivities, the prices are rising quite sharply, and incomes are not rising quick enough. I mean, if you look at the price of domestic commodities, if you look at the price of a 50 kg bag of gari, it is up 77% month on month to around 23,000 naira. If you look at a basket of onions, it's up 43% to 46,000 naira. If you look at the bag of rice, it's up 40% to 45,000 naira. Sugar, all of these commodities, most of the commodities that we track are trending upwards. And the key drivers, we have, the weaker currency that is for these commodities that have imported content like wheat. So one of it is the exchange rate pass through from the weaker exchange rate. Two is the flooding. The flooding that happened, I think, a couple of months ago, submerged quite a lot of farmland, and that has affected the supply or the availability of these commodities domestically, and that's contributing to the rise in prices. We also have issues about insecurity of transporting some of these commodities down south. So these factors are driving domestic commodity prices upward.
Right. Well, incomes need to find a way to match up with all the strain, consumers are going through right now. Thank you so much, Dr. Adesola Sumoni, analyst, Financial Derivatives Company. Thank you.
Thank you, Fab.